Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we are joined once again by Ella Dromgool, who is from Catalyst Financial. And Ella, you're a very special person, and let me tell everybody why. You're 26 years old and you own 2 investment properties already. And I think this is such a fantastic story because in the last episode, we talked about how people can get their first homes and that actually they can take action and they should do it sooner than they otherwise would have initially thought. Now, what I want to do is actually just walk through your numbers and your story so that everybody can see actually this person was able to purchase their first property when you were
21.
Exactly. Amazing. And that is so awesome. And we need to hold that up as an example. So walk us through, how did you get the first deposit, find the property, what did it cost, all of these things?
I guess for me, a lot of it came down to being financially educated about all of this. So growing up, my mum had a business. I worked for Westpac at the age of 17. So I had that financial background and was interested in numbers. I then studied accounting at university and really saw what people were doing within business and personal accounts through being an accountant. So I had a really good understanding of finances and saved pretty hard. Worked every school holidays, worked over the Christmas break, worked at uni as well. A good thing that I actually do remember doing is at university I worked 20 hours a week for a company called Xero. It's very cool to work for, and I used to get all my student allowance out every week because it's interest-free money. Okay. I took that money, put it in the bank, took my course-related costs, put it in the bank, and by the end of uni, I had pretty much 20% deposit sitting there to buy a first time.
That's amazing. So just again, so student allowance is the one you don't have to pay back. Student loan is the one you do pay back. Which one did you get out?
You get living costs per week, which you have to pay back. Student allowance, if your parents, I think there's a threshold, if they don't earn under or over that amount, you don't have to pay that one back. And course-related costs, you do have to pay back.
Yes, and course-related cost from memory is about $1,000 a year. So you were taking out as much loan as possible because it's interest-free, popping it into a wee bank account and then using that as your deposit.
Correct.
That's amazing. I never actually thought about that. That's genius.
That's great. And how did you actually afford to live? Just through working?
Yeah, so I worked 20 hours a week. I mean, at uni, you don't really go to uni 20 hours a week, so...
Oh.
And were you living with mum and dad at the time?
No, it was in Wellington, paying some pretty hefty rent. I think it was about $200 per week, which, 6-7 years ago, that was quite a bit of money.
Yes, especially as a 20-year-old or 19-year-old. So it was working a lot, so you're covering your expenses that way. I love this idea of the student loan. I never thought of that.
He's feeling very disappointed that he missed out.
Well, I'm just thinking, why didn't I do that? That's genius.
Not smart.
Because although you have to pay it back, that won't count against your deposit when you go and purchase a property. Now, of course, because you're paying a loan back, that affects your serviceability, your income side, but not deposit.
Correct. And it doesn't actually matter the amount of loan you've got either, because those kind of payments are based on the amount of income, and then it's a 12% above 20,000 or whatever the calculation is.
But I think a lot of university students get those course-related costs and they go, "Whoa, let's have a party. It's a week, you get $1,000, you go wild." Or people don't actually work during uni, and I know a lot of people do have study that requires a lot more hours than say commerce, but for a lot of people it is achievable.
So walk us through that first property you purchased, and understandably that this is like 5 or 6 years ago. Where was it? How much did it cost? What sort of deposit did you have?
Cool. So it was in Woodville Street in Edgware. So not quite, I'd say.
So Christchurch?
Christchurch, and Edgware is probably one of those areas that's a kind of mid socio-economic group, right?
Yeah. So it's close to town. It's a pretty family sort of place to live. That cost me $420,000. I bought it at auction, which was pretty intimidating for a 21-year-old.
That was your first purchase at auction?
Yeah.
Amazing.
I actually would recommend, I had this lady who bid it on my behalf because...
Was she an agent or a buyer's agent?
She was a buyer's agent.
So she worked for one of the real estate firms?
Yeah, she worked for Harcourts.
Okay, and she actually truly worked as a genuine buyer's agent. Did you have to pay her?
No.
Wow, that's great.
Yeah, I think now she may charge because she's so efficient and good at what she does.
And what was her strategy, do you know?
So she asked me what the price that I would, if I got it, I'd be so stoked for, the middle price and then my maximum price.
Yep.
And because when you're auctioning with all that money, if it's your own money, it's pretty intimidating,
yes.
But giving that responsibility for someone else is, and I remember her saying if I was going to auction, there'd be no way that I could actually bid on with my own money.
Yes, because then you get caught up in the emotions of it all, right?
Yeah.
That's amazing. And let's leap to today. That 420 property, what's it worth now?
560.
Great.
So that's a good 140K equity gain, especially because you will have been paying down that mortgage, and we'll go into how you did that quite aggressively in a moment. But even in what's typically considered as being quite a flat market over the last couple of years, 140K equity gain is significant.
And I think part of that is probably buying in. That's probably an area that I would consider up and coming. Certainly a lot of change happening around there. A lot of those older houses being replaced now, close to the CBD where there's huge population growth. Not that that's not the only driver. All those sort of things that are happening around to push that price up more than some of the other houses have.
And talk us through as well, Ella, you managed to purchase an investment property not that long after. So you bought this property on Woodville Street for the 420 and used a 20% deposit in order to be able to do that. So that's about $84,000. So how do you create enough equity or enough deposit within that property that you can pull that out and purchase another investment property?
So I had 3 flatmates living with me at the time in Woodville Street, and they were paying a little bit of money each week. By doing that, I was using a revolving credit or managed loan facility with my property. So what that means is that my loan was offset against my income and whatever savings was in that account. So I just put all my savings in there, and when it came to buying an investment property, I managed to top up my mortgage a little bit more with the equity that I'd built, and then took those savings that I probably got from my 3 friends at the time and put that into my investment property.
And how much were you charging them each per week?
$150.
So $450 extra coming in every week. I mean, most people don't have that left over after they pay their bills. That's pretty impressive. And that goes straight down to reducing debt, which we're going to talk more about the structure around that in the next episode. But that's significant. What was it a year?
There's about $23,400 additional worth of payments. Now, that's not strictly coming off your principal because some of that's going to potentially be going against your interest. But
you're paying those payments anyway.
Yeah, actually, that's what I was just about to say.
Principal payments.
So it's additional principal payments, which is going to further reduce your interest costs. So that means more of your payment is going towards the principal as well, which is really, really good in that case. So how long did it take you to then go and purchase your investment property after you'd purchased this place on Woodville?
Yeah, so it probably took me 18 months. I was definitely looking for something a little bit smaller, not as high maintenance. Woodville Street's a pretty big section, family home, a lot of garden. Old.
It's the traditional investment property, right?
What I wanted when I was 21. I saw the white picket fence and thought, hey, look, I'm going to live there forever. Turns out I lived there for 2 years.
Wanted something smaller to then move into. So how much did it cost to purchase your investment property?
$360,000.
God, that's a cheap house. Isn't that amazing? And talk to us, what are the details of that? Where was it? How many bedrooms?
Yeah, $360,000. It was in Maryvale on Russell Street. 2-bedroom, freshly renovated, easy, low maintenance, no garden.
And what did that be worth now?
Well, I'd say over 400, Ed.
Amazing. And the interesting thing, of course, and I think this is really cool, is that after that, you went overseas. Am I correct?
Yes. So I've just returned. I was living in France for the past 2 years, traveling for the first 6 months. Just lived off rental income, a lot of savings that happened in the last 2 years before going overseas.
And the cool part about this is Ella's been able to make 180 odd grand, maybe more, without actually having to do much more than just buy some properties and sit on them.
That's right.
And the best thing there as well, Ella, is a lot of people will go and do their OE first. So they finish up uni, we'll go and do our overseas experience, and then I'll come back and maybe I'll purchase some property. You've done this the flipped way. And the really good benefit of that is, and this is illustrated by your property in Woodville Street or Ave or whatever it happened to be, where you had an equity gain of 140K over about 5 years. You were able to go ahead, live it up in France, while your properties are still increasing in value over here. So you've had more of that time in the market, and that's what's benefited you now.
What's your plan next?
I'll do a bit of work, I'd say.
Yeah.
No, pretty excited to get back into mortgage advice, educating young people, helping investors further. And just making money not as such a taboo topic.
Fantastic. Let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. And please don't forget to tune in tomorrow where Ella is going to join us again. And we're going to be talking about more detail into that revolving credit strategy, which she just touched on in this episode. So make sure you're looking out for it tomorrow. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nichols.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.